Hi, I'm Jimmy. In this video, we're looking at an update on Intel stock, ticker symbol INTC. We're going to look at the basics of Intel's business. We're going to look at the impact of their recent Mobileye spinoff. We're going to look at where Intel's trying to go in the future, and ultimately, what's the fair value for Intel's stock. But before we jump into that, I just want to tell you real quick about an investing platform that we're building. So we've got our private investing community hosted over on Discord. On Discord, we got a whole bunch of different investing channels where we all talk, share ideas, do some research projects together, and ultimately try to get better as a community at investing. We also do a couple investing live streams, private investing live streams every week. We do a valuation live stream. We do a portfolio live stream where we talk about my portfolio. We build the different portfolios. Plus, we do a research live stream where we try to analyze companies together and go through the process together so we could all get better at it. Okay, now let's look quickly at their business segments. So their largest business segment is their client computing segment. It accounted for about 51% of revenue over the past 4 quarters. This is where they have like their gaming chips, connectivity chips, things along those lines. Then they have their data center and artificial intelligence products. Then finally, they have the products that they make for network devices. Then they have their 3 smaller segments. This is their graphics, foundry services, and Mobileye. And we're going to touch more on those in a second. But for now, let's have a quick look at the recent Mobileye spinoff that Intel completed. So in October of 2022, Intel completed an initial public offering for Mobileye, which essentially means that Mobileye is now trading as an independent company. But one of the criticisms that came across some of the headlines was that what Intel received for this was about $861 million. Considering they paid about $15 billion for this, a handful of years ago, it seems like they might not have made the best possible deal. But I think the devil's in the details here. Because if we look at Mobileye, well, all total shares outstanding, there's a bit over 800 million shares totally available in the company. Right now, the stock is trading at about $26 per share. Well, $26 times 800 million puts the value of the company, the market cap of the company, at about $21 billion. But how many shares are actually publicly traded? Right now, there's a bit over 50 million shares that are publicly traded under Mobileye stock. The ticker symbol, by the way, is MBLY for Mobileye. The other 750 or so million shares are controlled exclusively by Intel. Not only that, but Intel also has increased voting rights with those shares. Those shares get 10 times the votes of a typical share being traded for Mobileye, which means essentially Intel controls the entire company. They control the entire company. So the $861 million was really extra cash that they received to list the company publicly. Now, this is important because we can't forget Mobileye is a public company. The public company is worth $21 billion. Right now, Intel's value is a bit over, it's like $120 billion. So the fact that they essentially control Mobileye is an important point to keep in the back of our mind. Now, because Mobileye is a controlled company by Intel, it's also important to remember that the numbers, Mobileye's revenue and profits and cash flow, will still be reported on Intel's books. It's very important to keep in the back of our mind. Okay, now let's jump in and look at the future of Intel's business and where they're trying to go. So one of the big headlines to come out of Intel's most recent earnings report is the cost-cutting initiatives that they're putting in place. They finally put some numbers to it. So in 2023, they're expecting to cut about $3 billion in costs. This should reduce their expenses, in theory, down the road, improve their overall profit. By 2025, they're expected to cut somewhere between $8 to $10 billion. That's by the end of 2025. So again, what they're trying to do is they're trying to make their company a bit sleeker, a bit more dynamic, a bit faster. They had too much, call it excess fat, too many expenses from when they got big for a long time. Now they're trying to sleek down and try to make themselves a bit more dynamic for the future. Now, the main point of their future, the point that the CEO pushed for when he first became CEO in 2021, was their IDM 2.0 model. Ultimately, IDM, by the way, stands for the Integrated Device Manufacturer. Ultimately, this means that they design and build their own chips. Now, some of the things that they're putting in place to try to offset some of the problems that they've had recently is they're trying to expand how many factories that they have all around their globe. They're putting one up in Ohio. They're putting some up in Germany. They're going to popping up factories all over the place, and they're spending a ton of money to do it. Come back to that in a minute. The second main point that they're doing in the IDM 2.0 strategy is to increase the number of external foundries that they're using. Now, historically, they've already used external foundries, but they're going to do more of that if it helps improve the quality and the speed of their production process, which I think is exactly what is necessary for a company like Intel. And then finally, they're also going to provide foundry services to other companies. So if another company wanted to build chips, well, Intel would essentially build it for them under their brand name. So overall, the IDM 2.0 is how they are expecting to become more competitive with companies like NVIDIA and AMD. And this is absolutely necessary if they're going to keep up, if they're going to try to remain competitive in the industry. It is absolutely necessary that they can design chips quick, get them completed, and ship them out. There's been far too many delays, which has killed the stock price. That being said, let's jump in to look what the fair value of the stock could be. So this is the DCF calculator that I mentioned earlier in the video. And basically what you do is you punch in the ticker, we put in Intel, and it kicks back a fair value. After some adjustments that we made, we got a fair value of $45 per share. So ultimately what happens here is we take analyst estimates, those are the green numbers down there. We take analyst estimates, and we went a little bit further. Typically the website gets 3 years of analyst estimates, although in this case we got 4 years. Now we can see that early on, Intel's free cash flow numbers are extraordinarily low. And that is completely understandable. This goes back to the IDM strategy that we were talking about before, where they're building a whole bunch of new factories around the globe. That is why their free cash flow numbers are so low. They're bringing in a ton of cash. They're spending nearly all of it to build all these factories and expand their business. Well, in a couple of years, a lot of those expenses are expected to go away. That's the reason free cash flow numbers are likely to pick up. Well, if the free cash flow ends up anywhere near these numbers, well, the fair value would be about $45 per share. Right now, the stock is trading around $28 per share, so there appears to be tons of upside for this stock. It also has a 5% dividend yield, which again is a good thing for investors. Now, I didn't include a margin of safety in this particular calculation. Typically I do, but I've been hedging against that a little bit recently because I believe very much that margin of safety should be assigned based on our interpretation of risk. Early on, when I first analyzed this company, well, I was using a 25% margin of safety, which means in this case, $45 fair value, take away the 25%, we should buy it less than $34 per share. But that was before they've taken a lot of the initiatives. I like the initiatives that they've taken as an organization. And because they are going down that road, I believe the company needs less of a margin of safety now. But again, I'm going to leave that to each individual investor as to what they believe should be the correct margin of safety for a company like Intel. But I know for me, where I bought my shares, I'm more than happy to sit and hold this stock to see how it plays out over the next few years. Now, if you'd like to sign up to get access to the website, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.